And we really appreciate all of our panelists being here today with us. We know that there are so many questions all of you have about COVID-19 and the effect on your business. Able to present that to you in a great way, so you could actually interact with our panelists. And we did submit some questions ahead of time that all of you were able to do that, and we have those being answered today by the guests that are joining us and our industry experts. So we did take your questions in advance, so we did work those into what we're going to talk about today. And also, if you have additional questions, if you could just put them in the chat, and if time allows at the end of the session, we'll absolutely take those as well. And respectful of everyone's time today, we do have, we allotted 45 minutes for this. So that way we can get everything addressed that you'd like. And then, of course, we encourage you to connect with the businesses involved today afterwards for any help that you should need. So let's get started. Today we have with us industry leaders, Derek Zambino, who is the business development leader for Assured Partners, Carmen Magistro, who is the group manager and administrative vice president of M&T Bank, Lars Anderson, employment and labor law associate at Hourigan, Kluger, Quinn Law, and James Clemente, CPA at Snyder, Clemente Accountants and Consultants. So again, thank you all for being here today. What we're going to do is basically start with each panelist, and I'm going to start with Derek and give them time to cover the questions you submitted and the most pressing issues that we know we're facing right now as a business community during COVID-19. So Derek, if you wouldn't mind, I'm going to start with you, and I'm going to ask you a couple of questions and give us some feedback on those. So the first one I have for you is just to talking about our insurance industry, to tell us about business interruption insurance and if it's covered or not.
Gotcha. Well, first of all, thank you, Lindsay, for organizing all of this. I think that we're all in this thing together, and I think with better information, we'll be able to get out of this stronger, hopefully when this is all done. But the first question, I think, is the most important question that I get every single day, and it's whether or not the insurance policies would respond to loss of income due to the COVID-19 shutdowns. And I'll just start by saying each policy is different. So I'm going to give you a generalized answer. If you need to put a claim in, at least call your insurance company, put the claim in with them directly, and they'll give you their response back to your individual policy. But the short answer would be probably not. For the most part, the insurance policies have a couple exclusions in them. And when you buy an insurance policy, you're buying a contract, and it's a promise to pay contract. We promise to pay if these things happen. There are some things that aren't a part of that promise. One of them being virus or bacteria. There's a virus or bacteria exclusion virtually in every insurance policy that is written out there. Some may be carving it back in, but for the most part, it's not covered. So the COVID-19 virus that is shutting down businesses is not going to be a covered cause of loss. The second portion of the reasons why the answer is probably not is because the business income policy also requires property damage to trigger coverage. And the question is, is there actual physical property damage to property due to this virus? And that is still kind of being determined. The third portion that is the biggest conversation piece is civil authority. So every business interruption policy has a civil authority provision that would warrant coverage if the government does shut down operations or shut down access. The sticking point to that civil authority is it must be caused by a covered loss in the policy. So go back to that virus exclusion. If the civil authority, which this one is, resulting from a virus, then there is no coverage for loss of income. I'll give you two examples to kind of basically make it hit home. So in 2011, when Irene and Lee came through Wilkes-Barre and the river rose, and the government came in and kind of evacuated downtown Wilkes-Barre and Wyoming Valley a little bit. It was, I think, a 5 or 6 day evacuation, and the businesses in downtown had to shut down, right, due to that government evacuation. For the most part, if the insurance policies of those businesses covered flood, then they would be able to recover loss of income, because flood is a covered cause of loss. That was the reason for that government evacuation. If flood was not covered on their policy, they wouldn't be able to, recoup for loss of income due to the government shutdown. So that is one example. Second example regarding civil authority may be a California fire issue, like the wildfires out there. If the, let's say the government shuts down access to roads that may impact businesses like shopping centers or manufacturing plants that would use those roads to get to those companies, and the government restricts access to those roads due to the fires, for the most part, fire is covered. So loss of income would be triggered because civil authority did not allow companies to be opened due to a fire. Therefore, we have coverage. So going back, short answer is right now it's probably not covered due to the virus exclusions, lack of property damage, and the civil authority provision is not triggered because of the virus exclusion in the beginning. So call your insurance companies, put a claim in, and they'll give you an exact answer based upon your exact policy. So yeah, that's the answer. Sorry. You know what, Lindsay, you're on.
I think Lindsay's stuck on mute.
Yeah.
Sorry about that.
Oh, there you
That's
go.
okay.
Thank you so much, Derek. And could you give us a legislative update with regard to lawmakers urging insurance industry to pay for loss of income claims?
Yeah, so as a result, a lot of these exclusions and denials from insurance companies regarding loss of income, a lot of lawmakers right now, I think 38 states right now are attempting to pass bills which would basically force insurance companies to retroactively remove that virus exclusion I talked about before. So it's in the process right now of being discussed in different state capitals and DC, and we're not sure what's going to happen. But it's being hit with a lot of restrictions right now, or resistance, I guess, mainly because, the argument is if the lawmakers, retroactively remove a portion of a contract, that will set precedent for contract law that may hurt, future contracts. The second argument from the insurance industry side of things is if the government retroactively removes that virus exclusion and forces insurance companies to pay, it would eat up their surplus. Surplus basically is like the insurance company's savings accounts. I'll give you a quick example of last month alone, the loss of income that would have been reported if there was claims would have been over $400 billion that would have been lost due to businesses not being able to operate. The United States surplus is sitting at $800 billion. So if you take last month's loss of income alone of $400 billion, we've already reduced that surplus down to 1/2 of where it is right now. And as that continues to go on, that may impact the solvency of the insurance companies, which may impact their ability to pay a car accident, a house fire, or a claim for tornadoes. So having the insurance companies be stable enough to pay future claims is a big part of the conversation. And so it's happening right now, every day, every week. We hear new updates, and as we hear more, we'll let you guys know.
Thank you, Derek. Can you also talk to us a little bit about what is being done to assist policyholders through this time of uncertainty?
Yeah, sure. So you probably have seen commercials out there on TV or newspaper ads or newspaper articles that talk about the majority of personal lines companies that write auto insurance have given 15% premium credits on March's bills, and they're actually going to be doing that for April as well. I have a list I can share with you on which companies have already agreed to do that. So in essence, what they're doing is, because there are less vehicles on the road, because we have a stay-at-home quarantine order, they're actually, recognizing that and giving you credits back on your personal lines premiums for automobile. On the commercial line side, they're actually allowing businesses to change exposures immediately. So for instance, sales can be reduced, payroll can be reduced. They're even allowing deferrals of premium payments on an individualized basis. So if you're unable to make a payment to your insurance company, I suggest reach out to the insurance company that has your insurance and work with them to figure out payment plans. I've heard of 60-day deferrals in premium payments. So companies right now are accommodating their policyholders at this time, because these are all uncertain times, and this is all new territory for all of us. So we're just trying to get through it together.
Awesome, thank you. And talk to us a little bit about workers' compensation problems and solutions.
So workers' compensation really is based upon payroll. And so when you have companies that aren't operating, but they're continuing to pay their people on payroll, that's an artificial impact to their premium dollar. So just last week, the Pennsylvania Compensation Rating Bureau just posted that they're aware of companies maintaining payroll, which is a good thing. And they are also aware that there's an artificial high cost when there is no exposure. So the rating bureaus are now allowing these businesses that are still supporting their employees through this tough time, when there's no business operations going on, they're allowed to allocate that payroll for workers' compensation calculations to a much lower rate per 100. I'll give you an example. So a manufacturing plant that has a bunch of employees in a manufacturing plant may be shut down for a period of time, but they're still paying their employees. The workers' compensation cost may be, I'll just use $5 per 100 of payroll. But when they're home, they're still paying that salary or that pay to the employee through payroll. They shouldn't be charged $5 per 100. Pennsylvania has allowed the payroll to be put into an office clerical rate, which is more like 22 cents. So that is going to help the calculation of work comp premiums during this uncertain time. The newest thing as of yesterday is a rule may come out that may enable businesses to actually not be charged for that payroll completely. It hasn't been passed yet in Pennsylvania, but instead of being charged 22 cents for that lower rated class, it may be no charge at all. So things are happening fast. And again, as we hear more information, we'll let you know. But insurance companies are aware that there is less exposure right now because things are being kind of shut down. So they're accommodating us, and this is uncharted territory. So we're going to be able to get everybody through this.
Thank you so much, Derek. And I know that we'll loop back if we have any other insurance questions throughout. And I did want to move next on our legal side to Lars Anderson, shareholder and partner at Hourigan, Kluger, Quinn Law. So Lars, if you don't mind, we're going to do some questions. I know some hot topics to you now that have been submitted, and also I know some that you've been getting a lot of. So if you could start by telling us about government orders regarding life-sustaining businesses and the workplace safety measures that do have to be implemented.
Sure. So good morning, everyone. Lars Anderson with Hourigan, Kluger, and Quinn. As you all know, the governor issued an order shutting down all non-life sustaining businesses as of March 19th, right? Recently, a new order was put in place by the Department of Health regarding workplace safety that needs to be implemented for those life sustaining businesses that are currently open. You saw in the news recently as well that going on May 8th, looks like some of the restrictions are going to be eased with regard to some businesses, some additional businesses being allowed to open up. And so while we don't have additional guidance now on what safety rules they'll have to follow, it's safe to assume that as more and more businesses are allowed to open, they're going to have to comply with the Department of Health orders that are out there now or anything that's revised. So right now, if you are a life-sustaining business, you need to have put in place certain protective measures for your employees. The basic ones being maintaining your cleaning protocols and increasing cleaning of high-touch areas so as to disinfect them. The products that you should be using have to be approved EPA products. Additionally, you should be putting in place protocols for if someone gets sick or is infected with COVID-19 or suspected to be infected, what you need to do. Those basic ones, without getting into too much detail, are you got to close off and ventilate their work area. While you're supposed to clean and disinfect, they want you to wait about 24 hours before you do that. Reason being is, allow the virus to start to die on its own in that area so that your cleaning crew is not becoming infected while they're going through. So after you clean and disinfect, their work area and ventilate it, you're also going to want to clean and disinfect common areas. And you're going to want to tree out who they've been in contact with. And it's not just, the day that you find out, it's going back a 48-hour period of time and notifying those employees. And contact is within close proximity, so within 6 feet, for more than a 10-minute period of time. If you've had someone who's been sick in your facility, you're also going to want to start implementing temperature checks at your facility. And you need to notify employees if they're sick, they have to stay home. That's just a good one to do regardless of whether or not you've had someone who's been infected in your facility, but you should notify employees right off the bat or continually that, look, if you're not feeling well, if you have symptoms, stay home. That doesn't necessarily mean they're going to qualify for paid leave, or it doesn't dictate how you handle the situation, which can vary per incident, but you don't want them coming into the workplace right now. See, you've also been directed by the orders to stagger your start times and break periods so that people aren't congregating. Anything that's non-essential, your meetings should be virtual, your training should be virtual. And the big one recently is that all employees are required to have masks in the workplace, except for when they're eating or drinking, necessary to take them off. So if you're reopening, in the near future, you should be preparing to have masks for your employees. And then if you're open to the public, such as, the grocery store or other retail location, you need to make sure that people coming into your facility have masks as well, unless they have a medical reason not to. The big question I've been getting a lot of, well, what if I don't want to follow these? Or what if I choose not to follow them? Look, you're risking your license. Should you have one through the state, you're also opening yourself up to fines and other types of penalties. And so, while it may not be something that you want to follow, it's something that the government has the right to enforce upon you. The PA Supreme Court last week, when a business has challenged their closure, said that the governor had these rights and had the ability to take his action. So if they're going to enforce, which it looks like they will if we're not following, there could be steep penalties involved.
Thank you, Lars. Can you also explain to us the Families First Coronavirus Response Act, and specifically including emergency paid sick leave and paid extended family and medical leave?
So as everyone should be aware, on April 1, there's a new law that went into place, the Families First Coronavirus Response Act, which has two components, the emergency paid sick leave and the expanded FMLA, right? So a lot of people have been calling and saying, I want my 2 weeks of paid leave. Well, you don't immediately get that, right? So there's limitations on whether or not, one, you as a business qualify, and two, whether or not the employees qualify. So first, it only applies to companies of less than 500 employees. Companies with less than 50 employees have the ability for an exemption. That exemption is pretty narrow, but essentially it's going to break down to if providing that leave is an expense and financial obligation that exceeds your available revenue, you may not have to comply. Alternatively, if that providing that leave would reduce your workforce so that you can't actually operate, or that individual has a skill set that is necessary for you to operate, you may be able to get an exemption from it. But so for the emergency paid sick leave, you got to fit into one of 5 criteria, right? And the first one is subject to state, federal, local quarantine or isolation order. And the first thing I hear right off the bat is when people read that is, well, we have a shelter in place order. Doesn't that qualify? No. So CDC years ago put out guidance on quarantine and isolation. And under that guidance, the shelter in place order wouldn't fall under this law's local quarantine or federal quarantine or isolation order. So what you really have to have is a situation where someone has been directed by a local government, federal government, or state government that they need to isolate or quarantine. The next one is you've been advised by a healthcare provider to self-isolate. So you hear a lot about high-risk people right now. So anyone in a high-risk category whose medical provider says to them that they should self-isolate or they should not be in the workforce right now, those individuals will qualify under this criteria. The third element is experiencing COVID symptoms or seeking medical diagnosis. So this is someone who may have been exposed and is going to get tested, or this is someone who has been exposed and is going to get tested, or someone who already has been tested and tested positive. Next one is caring for an individual who is subject to one or two. So subject to the quarantine or isolation, or subject to the healthcare provider staying out of the workplace. Key thing here is an individual. So it doesn't have to be someone living with you. It doesn't have to be a family member. This could be a neighbor. This could be just about anybody that you're actually caring for, as long as they fit the criteria for 1 and 2. And then the fifth one is if your child is out of work or out of school because the school is closed, you can qualify for it. And then finally, there's a catch-all one, which is if there's experiencing other substantially similar conditions. And it's speculated that this was put in so that if COVID-19 turns into COVID-20, or that if the virus somehow mutates, so that they don't have to repass this law if we're not dealing with the coronavirus and something else. So under these 6 criteria, you get the emergency paid sick leave if you qualify, right? And so emergency paid sick leave, what does that give you? It applies to full and part-time employees. For part-time employees, you're going to take their average hours worked, and it's going to be a 2-week window for them to receive pay. So if they're on average working 20 hours a week, under the emergency paid sick leave, they get 40 hours for a 2-week period, right? And their pay, of course, it has to be complicated, gets broken down on which one they qualify for. So if you're qualifying for 1, 2, 3, then you're going to get your full rate of pay at a maximum of $511 a day for that 2-week period. If you're qualifying for 4 and 6, which is the caring for an individual subject to quarantine order or experiencing other substantially similar, you're going to get 2/3 the rate of pay for that 2-week period, up a maximum of $200 a day and $2,000 for that period of time. Then there's 5, and that's the caring for the child whose school is closed. This is the one that gets a little bit complicated because the expanded FMLA ties in with this. So the only time the expanded FMLA becomes applicable is in the scenario where you're caring for a child who is home from school. And in that case, you're going to qualify for both the paid emergency sick leave and the expanded FMLA, right? And so the expanded or the paid emergency sick leave is going to cover the first 2 weeks, and then the expanded FMLA will cover the next 10 weeks, because under the expanded FMLA, you qualify for 12 weeks of leave. The first 2 weeks are unpaid. The next 10 weeks are paid. And they're paid at 2/3 the rate of regular pay, a maximum of $200 a day, maximum of $12,000 for that period of time. So with the first 2 weeks being unpaid, the employee then becomes eligible under the emergency paid sick leave to get those 2 weeks paid in the same calculation. A couple of key things to remember for this is for the expanded FMLA, it doesn't add additional FMLA time. So if you're an employer with over 50 employees and you're already having FMLA as a requirement for your employees, if they've used FMLA in the last 12 months, they don't get an additional 12 weeks of time. So if they've used, or if they've used 6 weeks already, they would only under this expanded program have an available 6 weeks open to it. open to them. Another thing to remember under this program, and this applies to both the emergency sick leave and the expanded FMLA, is it's only available if the employee can't work or telework. So if you set up accommodations or work with your employee that is experiencing one of these conditions so that they could telework, they wouldn't qualify for this program. And then there's a tax credit associated with. So anyone who pays it, there's a tax credit associated with it. And I think Jim or Carmen might be touching on that a little bit, but it's essentially a 100% tax credit based upon the wages you pay out under this program.
Thank you so much, Lars. That was a great explanation of that. And before we do move on to Carmen and ask him some questions on his side as well, can you tell us about the legal side of layoffs and furloughs, something that I know we've had a lot of questions about?
Yeah, so layoffs and furloughs, I mean, those are kind of legal terms, but essentially when you think of a layoff, that's a permanent termination from employment. A furlough is temporary in nature. So, the important thing when looking at and doing layoffs and furloughs is you want to make sure that you have objective criteria in place as to why you're doing it, right? Whether it's seniority, being the last one hired is the way you're going, or some other method. But you cannot do this based upon protected characteristics, or else you're going to open yourself up to a disability, or open yourself up to a discrimination lawsuit. So make sure you set objective criteria to use when deciding how to handle it. The other thing to remember is that if you're closing down, or if you have more than 100 employees and you're laying off 50 or more, there's a thing called the WARN Act. The WARN Act requires that you provide 60 days written notice and some other requirements in there to employees. And if you don't, then you have to pay them for that 60-day window period of time. While there's an exception, which deals with business necessity or unforeseen circumstances, the longer we are involved in this COVID situation, the harder it's going to be to make out a claim for that exception. So, if you get into that situation, it's just something you got to be careful and monitor. But a common question I get is, what do I have to do or put in the layoff notice or furlough notice? There's no magic words that you use. It's just you want to make sure that you're tailoring that message specifically to the employees and that you're clear and concise in what you're doing. Especially if it's a furlough and it's only temporary in nature, you want to make sure that they know when you want them back or what you're going to be communicating to them during that period of time off.
Excellent. Thank you so much, Lars. And we'll loop back again if we have a little bit more time today. But I do want to move on to Carmen Magistro. I know, Carmen, you're probably getting a lot of this on your end, but just telling us about the Paycheck Protection Program, an update on that and the current situation.
Yeah, thank you, Lindsay, and thanks for everyone for joining. There's really two pieces to the CARES Act that I wanted to discuss today. The first being the P3 program, which I know is on the top of many business owners' mind. And the second is the one that's currently being discussed. It's being called the Main Street program, and we have obviously less information on that today. But just to give you a little bit of background on the CARES Act, I mean, on March 27th, it came out. They had the P3 program, the Payment Protection Program, which has been significantly popular with business owners in a short period of time. Obviously, the funds exhausting last week, the first $350 billion that was allocated. Uniquely, the program was announced on the 27th. The application period that the SBA said that they were warranting was April 3rd, but information was coming out on the program on how it was going to operate and clarifications and different things from the SBA. I mean, we got some information on April 1st, then there was a further clarification, a final interim report from the SBA on the 2nd. Excuse me, on April 6th, after the program applications already started. So, the banks had to contend with putting through this conduit program at varying paces. And I'm not going to speak to any specific bank because every bank has implemented this program separately. During the process, there has been wildly different amounts of processing that has occurred at various banks, with community banks obviously having less PPP loan demand. They were able to process these through the system at a faster pace than, say, some of the larger national or large regional banks that may have been saddled with tens of thousands of applications in a very short time frame to get them processed. So what ultimately ended up happening was when the money ran out, there were a lot of small business owners that were left with a lot of angst because their process didn't get an SBA number associated for the bank, or excuse me, the SBA's E-Trans system. So today, or yesterday, I should say, the Senate did pass a bipartisan funding bill, which included, I believe, an additional, approximately 300 some billion dollars more to fund this program. It's set to go to the House, I believe, tomorrow, Thursday. And assuming the outcome from there is positive, you will see more funding go into this program, which should alleviate some of that stress. Unfortunately, just, and this isn't a political comment, is just fact. What's happening, sometimes in the House is that different things are getting attached and things aren't moving through. We're assuming at this point, because the clamor for this small business funding is so strong, that there's a very good chance that this could go through. So what does that mean for borrowers that already have applications with banks that haven't been processed? Over the last week or so, where let's say about $30 billion a day were getting executed through the SBA from this program, which is very considerably significant volume in dollars and applications, we actually expect this money is going to start moving even faster because there are tens of thousands of applications that are already in the system waiting to be processed through the E-Tran SBA system to get their SBA numbers and ultimately their notes from their bank and then funding for it. So, I do suggest that if anyone has interest in applying for this program, that they do go to whatever bank that they do business with today and inquire if they're still taking applications or, if they're queuing up for the process. Every bank is handling this different. Some have specific criteria that they're only going to handle a certain subset of business size, a certain category of size of business. Others have paused due to their volume of what they already have that they were unable to get processed. But regardless, if there is interest here, the original program was supposed to go to June 30th, I believe. So I think, assuming this funding gets passed and seeing how the demand for these dollars go through the SBA, I'm assuming that this may be something due to the popularity of the public and the small business owner that may see even some continued funding, hopefully. So that's just a general update on what's going on. Obviously, the payment protection program was put in place to help businesses that had 500 or less employees with up to a $10 million loan. The 500 employee number is kind of a guideline, but the SBA does have a sizing table that based on NAICS code could actually have more than 500 employees. So if you're in that situation, work with your accountant or your attorney or your CFO, what have you, and look at that to see if you qualify. It's certainly something to look into, because if you are able to secure funding, there is a high percentage chance that 75% of the funding goes for payroll, that there is forgiveness in the program. Right now, they're looking at 75% towards existing payroll, and then the remaining 25% can be spent on things like mortgage interest, lease rental, and then utility costs. The forgiveness of the program is important. From the day that you're funded, You have an 8-week period and where these funds are to be exhausted pretty much to support your payroll. I think that there will be additional guidance that comes out of the SBA related to that as this program matures, because there are a lot of questions that remain to be answered, specifically if you have furloughs and you're trying to bring back full-time equivalents. But, you know, as Lars had mentioned, there may be some concern about, you know, health concerns or, you know, a myriad of different things that could come up that we're waiting to get more information from the SBA on. So hopefully the program will have another boost of funding put through it tomorrow, which will give some business owners relief. And, you know, we'll see how it progresses over the next couple months. I know that there's been a significant amount of companies in our region that have applied. And the good news is a significant amount of the ones that I know of in our region, just from conversations, have received funding or have gotten an SBA number, just waiting on their signing of their note documents, et cetera. So that's a P3 update. The next program, which is a little bit less talked about and has to deal more with a larger company, a middle market size company, is the Main Street program. And this is much different than what the P3 program was set out to be. You know, these are eligible companies can have up to 10,000 employees or $2.5 billion in revenues. These are less a conduit program such as the P3 program and more of a traditional underwriting program at a bank, where the Federal Reserve essentially is willing to buy about 95% of this loan balance that's issued. And there's a lot of maybe traditional, what I'll call traditional underwriting parameters around these types of loans. And, you know, interestingly, this was one of the first pieces of the CARES Act that was announced, that the Federal Reserve was going to hold up about $600 billion to leverage for these loans. But it's due to the complicated nature of it and them wanting to get it right, there is a lot of question and answer period going through the Federal Reserve, banks, industry leaders, et cetera, related to the initial terms that they released. So the structure of these is going to look more like a traditional loan, where they can have up to a 4-year maturity, the principal and interest of which will be deferred for about a year. Uniquely, this will be a SOFR-based loan, not a LIBOR-based loan. At least that's the initial guidance that came out. So the pricing index that they're going to use is going to be a little bit different than what we've traditionally seen. And that has to do with the changeover from LIBOR to SOFR in the next, by the end of 2021. There will be some traditional origination fees and then SBA fees, or I should say Federal Reserve fees, for this program that go through that. But one key metric that they did come out from, I guess, an underwriting standard was company leverage that they're going to look at. So they're going to look at a 4 times funded debt, or excuse me, total debt to EBITDA ratio when they look at this. So what does that mean? To put it simply, if you have $1 million of EBITDA, free cash flow on your annual statement, what they're going to say is one of the limiting factors to loan size is that you can't have more than 4 times that amount in debt. So if you have $1 million in free cash flow, you can have up to $4 million in loans, including this loan that you get that's backed by the Federal Reserve. These loans will typically be a little bit larger than what we see in the PPP loans. And additionally, there will be restrictions on certain things related to company capital, stock buybacks, and special considerations for restrictions on compensation. This program will probably get a significant amount of scrutiny based upon what we've seen in the recent news, where There's been some complaints that certain companies that, for instance, applied for PPP loans maybe should have been excluded from the process because they weren't necessarily small business, et cetera. Whatever that looks like right now, to take the political lens off a bit, you know, the SBA, specifically the Treasury, and then the Federal Reserve are developing these programs, and the conduits, the banks, and basically all the clients or small business owners are trying to navigate the minutia to make sure that they could support their employees and their company during this disruptive time. The final piece, Lindsay, that I want to talk about related to that is, you know, there's been a lot of economic data that's been flying around. And recently, you know, there's been a lot of nuance to, should we, you know, open faster? Should we listen to scientists and doctors? Should we worry more about the economy? Don't have those answers, and I don't expect to speak to them right now. But what I do want to say is that the economic impact in speaking and reading and doing different things, I mean, there is a significant chance that, depending on the prolonged nature of this COVID-19 response, the shelter-in-place orders and different things, that, you know, in a consumer-based economy, when you're having 4 to 5 million people that are going and applying for first time, unemployment benefits, et cetera, even though we're putting stimulus, the government's putting stimulus in place to try to prevent you know, the decline, there is going to be a pretty significant impact in the short term. And the outlook in the long term really depends on the amount of time that the shelter-in-place orders kind of stay in place. So one of the things that I looked at recently, and Luke Tilley, who does one of the economic forecasts for the chamber, he's a chief economist for Wilmington Trust, had kind of set out, was they looked at this in 3 different ways over 3 different time frames. And, you know, with the worst case scenario being very dramatic, you know, 90 days, everything's shut down, or even longer, you know, the millions of jobs that can be lost at the high end, they're considering maybe up to about 30 million jobs. They're looking at a 60-day window where they're probably looking at about $17 million jobs, 17 million jobs, and then obviously, you know, a shorter window, which I think we were actually already through from when this discussion point came out. So, you know, to put all of that in context around some of these financing vehicles that the government's putting out and that banks are trying to work through, I think the stimulus plans are good as long as the money gets to the small businesses. I recommend that you go to work with your bankers or your CPAs or accountants to kind of get some depth of scope on some of these programs. I think the PPP program is very simple. Hopefully it does get refunded. The Main Street program, there'll be more to come. So that's what I have for an update, Lindsay.
No, that's excellent, Carmen. Thank you so much. That was really in depth, and I think it really gives us a look forward to what businesses can expect on that end. So thank you. And I know we do also, just as a side note, before I know we're going to go to James Clemente to talk to us a little bit about some of his questions right now that he really has been getting a lot of and help us out in the accounting and finance field. But we have been getting some questions a lot on Facebook and in the chat. And while we won't have time today to address those, we will get those to the correct party. So all of our panelists, and then we can get those responses to anyone that should need them. So thank you for submitting those, and we'll make sure that we get those answered for you. So James, if we can bring it to you now to close this up and talk to us a little bit on your end. And I know first, if you want to tell us, you know, some highlights of the individual income tax provisions under the CARES Act.
Yes, thanks, Lindsay. I'll be talking little highlights of the individual tax provision under the CARES Act. Then I'll follow up with some of the business tax provisions. Then I'll lead in a couple other upper items, Lindsay, and thanks for having me here. Under the CARES Act that was passed late last month, a couple big changes for the individuals. And I'm going to do a highlight because they can get a little granular to talk to their financial advisor or accountant about it. With retirement plans, there's a lot of 2 big changes. The RMD, the required minimum distribution, is waived for 2020. That's a biggie. That's when, if you're over 72, it was 70 and a half, now it's 72, was going to be 72. years of age for 2020, it's waived. So if you don't need the money, you don't have to take the money, and there's no penalty because there's no required minimum distribution. That's a biggie. The other big change in retirement plan distributions is the waive of the 10% penalty if you would otherwise be subject to it because you're under 59.5 or some other rules, but basically under 59.5. If you need the distribution for a coronavirus-related issue, which is not only having disease, but got laid off, furloughed, or to work reduced hours, pretty general, pretty broad definition of the ability to receive a distribution up to $100,000 for 2020 and not have the 10% penalty. More importantly, is you could take that $100,000 and not pay tax on that until over a 3-year period, ratably, like it would be $33,000 a year for 3 years. So you could take the 100 and pay the income tax on the 100, again, waiver of the 10% penalty for a 3-year period. More importantly, they give you the ability as you go along to roll that money back into your plan. So it could be looked at as a temporary loan with no penalty. So you could take the money and each year choose to roll the money back in instead of paying tax on it. And you have that 3-year rollover ability, just like you have your 3-year ability to pay the income tax on the minimum distribution, not the minimum distribution, the distribution you had to take out because of a corona-related virus issue. So they're too big on the retirement plan field. They expanded the educational assistance programs. That's a lot of employees or some employers have the ability to do educational assistance programs. They set it up. That's paying for educational assistance, normally higher ed or schooling for employees up to $5,250. There's non-discrimination rules to set it up. But a lot of larger or even smaller companies set it up so you could go to get higher education. It's a tax-free fringe benefit for the employee. They expanded that ability to use that $5,250 this year for student loan debt payments. That's a big one. So in the past, an employee had the ability to use those funds if the employer had this program set up, educational assistance program set up, and they had to use it on schooling. For this year, the employer could pay your student loan as part of that $5,250, and that becomes a tax-free fringe benefit for this year under the employer assistance program, employee educational assistance program. That we'd have to have the plan set up. You have to meet all the other rules of the plan. Non-discrimination is the big one. You can't pick and choose who you're going to provide that benefit to. Finally, on the individual end, they changed the charitable contributions, trying to enhance more charitable contributions in 2020. You get not a large number, a $300 above the line deduction, as we say, if you don't otherwise itemize, and you use your standard deduction to take a $300 charitable contribution, of course, if you gave to the qualified charities. And for large charitable individuals, the limitation of how much you can give away each year, which is based on 60% of your adjusted gross income, that's waived. So you can give a larger individual charitable donations, not being limited to your income restrictions. 60% was the income restriction going in this year for 2020. So they're the big ones on the individual. I'll get into the business. Now this could get a little granular, so I won't do that. I'm going to give you the highlights that you then talk to your accountant or tax advisor about, but a couple big ones. There is an employee retention credit in effect for 2020. If your business suffered loss of gross receipts of greater than 50% in any quarter, starting the second quarter of 2020, measured based on the prior quarter in the past, year over year quarterly drop, you can get a benefit at up to 50% of the wages paid to those employees if that business met that drop in revenue recognition, up to $10,000 of wages or 50% thereof, $5,000 credit. So those businesses that are experienced a huge drop in gross receipts starting in the second quarter of 2020 for the next 3 quarters, look at those numbers, talk to your financial advisor or accountant about it. If you qualify for this payroll credit, that could be up to $10,000 of wages, 50% thereof, a $5,000 credit. So that's a big credit. They also give you the ability if you're affected by this coronavirus, and we all are, a delay in paying your payroll taxes. Starting in the second quarter for the next 3 quarters, if you cannot pay your payroll taxes, and it's a fairly easy rule to meet, you could be delayed in paying those payroll taxes you would otherwise have to pay, no penalties and interest associated with it. And those payroll taxes that you're having the ability to delay for the last 3 quarters of 2020, you pay half in 2021 and half in 2022. It's like an interest-free loan on your payroll taxes. Your payroll service companies are setting this up. If you're using some of the larger ones, even the smaller ones, they could guide you through how to go about the process of delaying those payroll taxes and notifying the IRS you're taking advantage of the delayed payroll tax recognition. There's a lot of changes in the net operating loss rules. They can be a little granular, so I won't get into too much detail. You weren't able in the past to take operating losses and carry those back to get refunds. Starting now, operating losses in 18, 19, and 20, you could carry back up to 5 years. So if you had operating losses in 18, 19, and 20, you could take those operating losses and carry back for refunds. Prior to this, a net operating loss on the individual level from a pass-through entity or at a C Corp level would only be allowed to carry forward. They also eliminated the rule that was in effect that any net operating loss could only limit 80% of your taxable income. Now it's 100% of your taxable income. So in the past, you could have significant operating losses that exceeded your taxable income for the current year. You only use it up to 80%, meaning you would still pay tax on 20%. That's eliminated. You could take the full advantage. And on the individual level, they eliminated non-corporate taxpayers. That's people that have S Corps and partnerships that are reporting the losses on their individual return. Those losses were limited to $250,000 net of all business losses. That's now waived for 2020. So if you have those large losses, you could take advantage of those and reduce your taxes. They changed the deductible interest expense rules. I won't get into those details. There's a lot of details on what you could do or not do with your interest expense, normally for larger companies, but some larger companies are affected by a limitation on deductible interest expense. A big one is the bonus depreciation on leasehold improvements to realty. A lot of real estate holders and investors it applies to. This is a rule that in the past, if you put for 2018 or 2019 or 20, you put leasehold improvements into your building, not expanding the building, not buying a new building, but an improvement to the interior part of the building. In the past, meaning 19 and 20, and so up to now to 20, you would have to capitalize and depreciate over 39 years, not a favorable tax treatment. They changed that. So if you're a landlord and you put in $100,000 of leasehold improvements in 2020 or in 19, you could then deduct those on your return in full as a one-time deduction. So take a close look at what's called bonus depreciation on leasehold improvements. If you have those in your business, talk to your accountant or tax advisor for that ability to write those off in full. So that was a quick of the individual and business provisions. Lindsay, I'll expand a little bit on the PPP loan that Carmen touched on a lot, and then I'll talk about the individual recovery rebate. That's the $1,200 or $2,400. Carmen talked a lot about the PPP loan and how it's forgiven, tracking those 8 weeks through payroll fringes, rent, utilities, and interest on mortgage debt. And what you pay during those 8 weeks counts towards the forgiveness. So important to track that. And we encourage a lot of our clients to set up a separate bank account when they receive the proceeds. So that as you spend the money on those qualified uses, you pull it from that individual bank account into your operating account and pay your payroll, your health insurance, your retirement plan, your rent, your utilities, your interest on mortgage debt. So you track it. The other rule you need to meet beyond spending the loan proceeds in 8 weeks is bringing your FTE back to a level that existed prior to the virus. And there's two measurement periods in the past. The most one that's used so often of the two is your average FTEs from January 1 to February 15th of this year. For example, if a business had 50 FTEs for that time period, then during the 8-week time period, you must grow those FTEs back up to 50 in order to get the full forgiveness that you otherwise spent. So if you got a $300,000 loan, you're able to spend a whole $300,000. You also have to bring that FTE count back up to those pre-virus levels to get the full forgiveness, or you will lose some of that forgiveness based on those FTEs not up to the full level. One exception to that is in the 8-week period, you don't meet that FTE threshold that you had previously. As long as you bring those employees up to the magic date of June 30th of this year, you get that will count towards you meeting that FTE rule. So we're telling our clients that what you need to spend during the 8 weeks, track that in that category we all know about, but also your FTEs need to get up to pre-Kronos levels based on 2 measurement periods that happened prior to the virus hit. So it's tracking your FTEs and spending the money. The last thing I'll just touch real quick is the individual recovery rebate credit. We hear a lot about it on the news. That's $1,200 per individual, $2,400 per married person, plus $500 per dependent child in that family. It's based on income limits. Individuals under 75, you get the whole $1,200 phased out between 75 and 99. Then after 99,000, you lose it. Married couples, 150 phase out to 198. The refund will be based on your an advance of that credit will be paid based on your 2018 return or 19 return if already filed. You don't have to do anything. They track it and pay it. If you don't file a return and you just have Social Security benefits, you'll get paid through that because they track your Social Security benefits and you'll get paid. So a return is not necessary to file in order to get the advanced rebate. And if you don't qualify for the rebate because your income is too high in 18 or 19, if 19 was previously filed, and your income's lower in 2020 under those thresholds, you will get the credit on your 2020 return. So you may, if you didn't qualify for 18 or 19 because you're above those income thresholds, but you're lower in 2020, you'll get that credit on your 2020 return. The reverse is even beneficial. If you receive the rebate based on your 18 return or 19 if filed by now, and in 2020 you didn't qualify because you were over the income limits, you don't have to return the money. So it's an interesting that if you were qualified in 18 and 19 you weren't qualified and your 19 return is over those limits, you wouldn't file your 19 return until you got your rebate back based on your 18 because you don't have to return that rebate no matter what your 2020 income is. So some people are holding off on filing 19 and letting that come in on their 18 return. Right now, the rebates are coming first on filed 19 returns, and then it'll go back on 18 returns, just how the system is set up with the Treasury. So Lindsay, that's my topics.
We really appreciate that. And I know you went through a lot of material quickly and it was all so important and relevant. So thank you so much. And I do just want to wrap up. I know we went a little long today, but I think it was all such great information. And we appreciate all of our industry experts so much for participating in this and helping our community during this time. So thank you all so much. And to everyone like I said, we're going to go through all the questions we've received both on Facebook and in the chat, and we will direct those to our experts so that we can get you those answers. And again, just want to thank, our community, our chamber community. We're here to help you in any way that you need as well. Work through this as a united community. Please don't hesitate to reach out to us. We are going to keep doing things like this. And like I said, we want to know what you want to learn about and how we can bring that to you during this time. So don't ever hesitate to reach out and connect with us on that. This will be part of a weekly series called Wisdom Wednesday. So you can again join us back here on Facebook and on Zoom as we learn more about e-commerce and online marketing to help your business. So thank you all. Everyone stay well and have a great day.
Okay, thank you.
Thank you.
Thank you.
Thank you, guys. Have a great day.
Bye-bye.
Bye.